Hello everybody, this is Chris Robbins from Grand Street Wealth Management, and today we're going to talk about rising interest rates in the current fixed income market. As always, you can go to grandstreetwm.com and click on blog to see all of our previous articles and videos. So here's a chart of the current term structure of Treasury yields, and as you can see down here on the short end of the curve, yields are at pretty historic lows. You're basically not getting much return on your investment if you keep yourself in the short-term maturities. But the conventional wisdom is this is exactly where you want to be. You want to be down here in the short end of the curve because as interest rates rise, you don't want to get stuck taking a large capital loss on these longer dated bonds, because the longer your duration of your bonds, the more capital loss you'll take, the more sensitive they are to interest rates movements. So the conventional wisdom is let's stay short term and stay away from these longer maturity bonds. That way when interest rates rise, we won't take a big capital loss. Now, one of the problems with this line of thinking is that because the curve is so steep, the market is already pricing in that interest rates are going to rise. And today we'll look at a quick example to see how the market is predicting these rising rates. So let's say that I'm an investor and I have a question before me. I want to decide I want to know whether I should invest in a 5-year bond currently yielding 1.43%. Or if I want to listen to the guys on TV telling me to stay in this 2-year bond, stay in these shorter term maturities, and then when interest rates rise, I can jump into a 3-year bond, and then at the end of 5 years, this will go up enough to make up the difference. So, to be able to figure out what our future value of these bonds is, we're going to use a formula. And that formula is present value times 1 plus the interest rate to the t power, meaning how many periods there are in that bond, and that'll give us our future value. So the first step we'll do is let's look at this 5-year bond, and let's see what our future value will be if we were to invest $100 in this 5-year bond. So my present value is 100. My interest rate plus 1 is 1.0143. That's my interest rate plus 1. All to the 5th power, and when we do that math, it's going to come out to be $107.35. So here's what the value of our position is going to be after 5 years in this 5-year bond. Now, alternatively, we'll invest in this 2-year bond. So, using the same formula, if we were to just invest in this 2-year bond, after 2 years, what we'd have is our $100 times 1 plus 0.0036 to the 2nd power. And when we do that math out, we get $100 and 72 cents. So we haven't really made much money on that after 2 years of being in that 2-year bond. But we assume that interest rates are going to be rising. So now we're going to invest in this new 3-year bond. But let's see what the market thinks the break-even point of what this 3-year bond is. So to do that, we'll say, okay, after 2 years, we have $100 and 72 cents. But if I were to take this amount of money and put it into a 3-year bond, okay, so if I were to put it in a 3-year bond, so using the same formula, I have my money after 2 years times 1 plus some interest rate that we're going to have after 3 years to the 3rd power, because it's a 3-year bond. Now let's say that this is going to exactly equal what we're going to have after the 5 years. So let's say that it's going to equal exactly what we had after 5 years, or $107.35. This will tell us what our break-even interest rate will be to invest in that 3-year bond. So to do the math on this, we can divide both sides by 100.72. That'll cancel that out. We can do a cube root here. Cube root on this side. That'll cancel this out. We can subtract 1 from both sides. That'll cancel this out. So we're left with I equaling the cube root of 107.35 over 100.72 minus 1. And when we do that math, it's going to equal 2.15%. So what this tells us is that if we're going to stay in this short-term 2-year bond and then reinvest in this 3-year bond, we're going to have this 3-year bond is going to have to equal 2.15% to give us the same money at the end of the day as if we were just to invest in that 5-year bond. So the market's already telling us that the 3-year maturity is going to go from 0.66% to 2.15%. That's like a 325% increase in the yield of a 3-year Treasury note. So the market is already pricing in a large increase in rates. So as an investor, if you're gonna try to play this market timing game of interest rates, you have to say to yourself, not only do I think interest rates are gonna rise, but I think interest rates are gonna rise more than the current term structure of the Treasury yields is already telling us. Well, that's it for this week. We will talk to you again soon.